Hey everyone, in this video I'm going to do a subscriber request. Subscribers requested to compare Fisker stock and Lucid stock and answer which one is the better buy. Of course, Fisker and Lucid stock have struggled recently and they're down significantly off their highs. So I can understand investors are curious about these two EV stocks. So let's get right into the comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first metric I'm going to compare Fisker and Lucid on is revenue. Interestingly, Fisker only recently started making deliveries and generating revenue, but already in the first quarter it generated 71.8 million in quarterly revenue. It's almost caught up to Lucid that has been generating revenue since about January of 2022. Lucid, meanwhile, is heading in the opposite direction. After peaking at around 250 million in quarterly revenue, it's been on a downward trend, generating 137.8 million in revenue in its most latest quarter. In the last 2 days, there's been some unfortunate news for Lucid stock. Today it was reported it needed to recall 2,000 of its vehicles, and yesterday it reported quarterly production and delivery numbers for the fourth quarter that disappointed investors. So that's the latest development from Lucid. Fisker, meanwhile, has been working. It just announced a deal with several dealerships. It's going to that model instead of going to the direct to consumer model because it had so much difficulty going from producing the vehicles to delivering the vehicles to customers. It didn't have that logistics network in place ahead of time, which is a little bit curious, right? This whole time you've known you're about to get production going, you've known you're about to make deliveries, but you didn't have the logistics in place. So that was a little bit alarming, and it's understandable that investors were concerned about Fisker following these mishaps in the latest few months. So the next thing I'm going to compare Fisker and Lucid on is their quarterly operating income. And this is going to highlight a big strategy difference between Lucid and Fisker. So Lucid is making its own vehicles. They've invested in the manufacturing capacity and everything is in-house. Meanwhile, Fisker is outsourcing manufacturing to Magna, a manufacturing company. You can see the difference here in quarterly operating income. Fisker, in its latest quarter, negative 103 million, compared to Lucid, negative 752 million. 7 times the loss, more than 7 times the loss, even though revenue was only, not even twice that for Lucid compared to Fisker. This really highlights the difference between outsourcing and bringing manufacturing in-house. When you outsource, it makes it easier to achieve gross profit sooner and operating profit sooner. Whereas when you bring all the manufacturing in-house, it makes it harder. It makes it take more time because you need to produce and deliver more units to reach that economy in scale. However, the plus side of bringing manufacturing in-house is you have more upside potential. Once you get past the pain points in the beginnings and you ramp up production and deliveries, you can achieve higher profit margins when you have manufacturing in-house versus when you outsource manufacturing. So it's a strategy difference, one that Fisker and Lucid are different on. They've chosen different strategies. It's too early to tell which one is going to be more effective. But for now, it's helping Fisker reduce those losses on the bottom line as it works through these pain points, whereas Lucid is losing much, much more money on the bottom line compared to Fisker. Similarly, with cash flow from operations, although this difference would have been even more pronounced if Fisker didn't have those logistics issues, because it hasn't yet transferred those vehicles that it produced to customers. And so it's got an elevated inventory balance. And so that temporarily is negative for cash flow from operations. Although once it gets its logistics figured out, its inventory should decrease and its cash flow from operations should improve and there should be a bigger difference between Lucid and Fisker. Still, Lucid negative 513 million in cash flow from operations, while Fisker negative 305 million. Although Lucid is making progress, it reached the scale where it's finally making progress in moving in the right direction and shrinking these losses from cash flow. Of course, whenever I look at companies that are losing so much money on the bottom line, I want to know how much cash they have, how much time they have before they run out of money. And they both have considerable amounts of money, with Lucid way ahead here with 4.4 billion in cash and short-term investments. Fisker has 529 million in cash and short-term investments. But if you look at Fisker, they went through 305 million in the last quarter. So if they continue at that pace, they have less than 2 quarters of cash available. So that is a little bit of a concern. Fisker needs to get its infrastructure settled before it gets really ramping up in production, because they don't have the cash to have this inventory just sitting around. They can't spend money making these vehicles just to have those vehicles sit around somewhere parked and not delivered to customers. So looking at average diluted shares outstanding, the number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. Now that you have an understanding of why this matters, you can see Lucid is diluting shareholders more significantly, from 1.8 billion in shares outstanding to 2.3 billion. Although Fisker has not increased shares outstanding all that much, I suspect they will, because they're running short on cash unless they improve their operations in this next few months. And finally, on valuation, I chose to use the price to sales ratio. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion, and the sales for the previous 12 months were 185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for 465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. All right, so now that we have an understanding of the price to sales ratio, you can see Fisker is trading at a forward price to sales of 0.090 compared to Lucid, which is trading at a forward price to sales of 1.789. So overall, I think both of these EV companies are in a challenging environment, and if I had to choose, my choice would be to not invest in either of these two until they get themselves in a better position. But if I had to pick one of them, I would pick Fisker just because the valuation is so cheap, so much cheaper than Lucid. I think it provides more upside for investors. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.